and Nifty has slipped below that 24,700 mark as well. Let's understand what has caused so much pressure in trade today and what can the outlook be for the rest of the week and in the near term as well. To do that, let's welcome on board Mr. Deepak Shenoy, CEO at Capital Mind Mutual Fund. And Deepak, hi, good afternoon. Thanks so much for joining us. What are you making of the kind of mayhem that we have seen on the market? Because key support levels are being broken on an intraday basis on consecutive days. So what's your take on the market right now, as well as in the near term, any scope of a recovery now?
Well, always scope of recovery no matter what. But I think one of the things that's probably weighing in right now, overall, perhaps, is the lack of a deal with the US when Europe is apparently, I don't even know if they've done a deal because you got announcements only from one side, not the other, and Japan and a few other things. So there's a lot of this, consternation happening, and it's generally very good. What we call volatility is like 500 points in the Nifty here and there. I think that's just like 2%. It's, if we don't move this much, where will we go? Honestly, 1%, 2% is not a big deal on an index level. Of course, some stocks are reacting to earnings, some stocks are reacting to generally low credit growth overall, though to be fair, the economy seems to be growing quite decently. We'll get numbers at the end of August, I think, about GDP. But in general, I don't feel that the economy is, meaningfully trouble or any of that sort. The results also seem quite okay, other than from some of the financials in the sector. And even there, I think there's a, good and bad. Overall, we're not seeing, miserable results in that sense, but we do see, some elements that are concerning, whether it's government flow in defense orders, changes in the infrastructure story not panning out quite as much as we thought, and some of the other areas around IT does cause a short-term risk or a short-term fear level. However, I don't see this as long-term. I think all of these things will go away. The government will spend; they have to, and when the concerns around jobs. Uh, every new technology creates jobs and takes away jobs. Usually it takes away jobs before it creates jobs. So it's just the part of the game. We've seen this in 20 years ago, and we'll probably see it now as well. And I don't think the numbers are meaningful, although numbers like 12,000 sound huge. It's on the back of like a 6 lakh people or 3 lakh people workforce. So again, small single digits overall. So I think, there are fears. Maybe some of it is driving down thought process, markets in terms of sentiment. But I mean, once some of these go away, we should see the markets recover somewhat and reflect the underlying economy a little more.
Well, so much impacting the market. So, Deepak, let's pick it up one by one. Let's talk about the bank's earnings. Yes, there is the good and the bad, but the unfortunate part is that the good is a little few. Largely, you've got ICICI Bank and even HDFC to some degree at the dominant position, and then there are the rest. I want to talk about the disconnect within the large private banks as well, because what you've heard from Kotak and Axis is that there's a problem in the MFI segment, and Kotak especially, because the MFI segment for them is actually minuscule. For them to come out with the commentary that they have, does that really indicate that there is some problem when it comes to unsecured lending and is not going to bottom out soon?
Honestly, Aisha, I think that has been a long time coming. RBI started early last year, saying that they want to curtail NBFC lending to the unsecured sector and then downstream into banks as well. So one of the problems that we've seen in general is when you are very harsh on one sector and say, I want to stop all lending. It's not the bad lending the bad borrowing that goes out the window. It's the good one also, because what happens is banks and NBFC start placing a lot of restrictions, increase interest rates. The interest rates have gone up, and even secured loans, banks haven't cut down interest rates on. We haven't seen a major cut down in the interest rates for even unsecured loans. And therefore, you're not getting good borrowers back into the system. And then if you have an increasing number of borrowers who are in some kind of stress, and the less stressed people are choosing to repay their loans and not borrowing anymore because you've increased requirements, made it onerous for people to apply because RBI was strict, then obviously the share of your bad loans will go up. I think they're being fair in this and saying that there is a problem in stress. But two things: RBI has removed a lot of the harsher mechanisms they've put around this. They've eased up on the regulations a little bit. Secondly, it takes time for some of these things to seep back into the system. So borrowing even by corporates is not taking up. The corporates are going to bond markets, getting better rates from there. Some of the SMEs are choosing to repay loans rather than have a large borrowing, even though it may hurt their ROEs. All of these are, I think, signs that the banking system perhaps has gotten a little more strict than it should, and they should ease up. If banks wanted, they could increase lending by reducing their rates. I don't know why they're not doing that. They're all quoting credit cost to us as if just because they have some bad borrowers, they have to charge everybody higher interest rates. That doesn't sound, altogether sane. You do need to reduce interest rates for people to borrow better, and better for better borrowers to come into the system. So at this point, I think banks have themselves to blame to a large extent, and it's not that all banks are bad. So some people are doing well in this market, and I think you will have to have some of the bigger banks also take the lead in cutting rates for borrowers.
I get that. But Deepak, as an investor, what do you do? Do you add more positions to ICICI Bank, HDFC Bank, or where you see pressure and the stocks falling almost 7% like Kota case today, do you add positions there?
Yeah, it's an interesting point because stock market falls usually tend to provide opportunities, but sometimes on the back of the fundamentals, they deserve it. I won't comment on individual stocks, but here's my key thing here is that there are ways to improve your margins in a low interest rate environment by because you naturally have expanding margins in the beginning of an interest rate cut. Because what happens is your borrowing costs come down first, and then lending costs come down lending rates come down a lot later, and they've not really reduced lending rates meaningfully. So, to the extent that banks have kind of enjoyed a little bit of that spread right now, they're not going to get that spread in the future when rates come down. So, at some point, if I would prefer to go with banks that are being more aggressive in a market like this, because this is the time to gain more market share. RBI has also eased the regulations on unsecured loans, which is and also personal loans in general. And you have a much higher. If you look at the bank credit in India, it is now significantly higher in the personal loans to individuals than it has ever been, and it is the way banks are supposed to be. They're supposed to be taking risks with individuals and with SMEs, and corporate lending should be much smaller. So 55 lakh odd crores is going to the to individuals, and this particular sector is more likely to see stress. So if especially if you curtail lending to that sector. So I think at this point, I would go with banks that seem to have demonstrated more resilience and have a more diversified portfolio. But in general, I would say the financial sector is perhaps less interesting right now because they're going to grapple with this for a while. The industrial sectors seem to be doing so much better. So maybe time to um, do asset allocation better rather than just focus on which financial to buy.
Quite interesting there. So tell me what to buy then. What's the simpler answer to this?
Well, I think the industrials are doing quite well. We're starting to get over. I mean, they're going to be trouble because if we get into an industrial economy, China is going to try and stymie us as much as they can because they don't want us to replace them in any meaningful way. We have the size, in the sense potential to become a reasonable size. We're very tiny right now, but we also depend a lot on China. India is the largest textile exporter, perhaps one of the largest textile exporters. We get 99% of our sewing machines from China. So why does India have to not make any sewing machines at all is a concern. Obviously, we'll address that in time, but we should. And during that time, if China decides to stop sending us sewing machines, our textiles sector will have to wait till our own manufacturing sector grows up to a certain size before they were able to, replace China entirely. So there will be problems in this sector, but I think if you have a 5 or 6 year approach, anything in the manufacturing, defense, railways, spaces where there is manufacturing involved, or creation of goods involved. I think that is where we're going to see a lot more potential going forward. Then the financialization of the economy. I mean, I'm very biased because we run a financial services company, but I think India is financializing almost every day, and over a period of time, you're going to see more and more people use digital finance to meet their needs, whether it is UPI which has kind of become everywhere, but also for their investments. People will move towards more financial investments than towards real estate or gold. So that is another area where I think the infrastructure elements in the financial area are companies that may benefit in the longer term. I think those two are key, but not so keen on commodities or financials more than the established financial companies don't seem to be able to benefit so much, but the financialization is better. And then if things move right, I think our infrastructure story should also start to do well, though it's taken a long time. And honestly, I've been waiting and saying this for too long, but I think that will also come back.
Yeah, lots in the pipeline and exciting times ahead. Deepak Shenoy, thanks as always for your time. We'll let you go on that note, and we're going to be chatting with Sharan Lilani as well on how the charts are looking. A lot of stocks cracking, markets pretty much around the session lows. We'll talk about all of that and movies on the other side.